From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Ferro. Day 4 of softness in U.S. equities as they digest hawkish prognostications from central banks around the world. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Coming up, stocks slump as central banks worldwide take a hawkish stance. Chair Powell doubling down on more rate hikes this year. And Prime Minister Modi heading to Washington as the U.S. and India look to improve economic ties. We begin with the big issue. The hawkish surprises keep on coming.
This is clearly a hawkish tone from the UK and from Norway.
We're facing still, globally, a serious inflation problem.
Central banks that have not quite done enough to bring down inflation.
Wage growth is still stronger than central banks would want to see it.
Central banks started out well behind the curve.
The Fed continues to tighten and remain hawkish.
This is the most hawkish pause I could have imagined.
The ECB does seem more hawkish than the Fed.
They're going to have to sound quite hawkish.
The need to tighten continues.
The U.S. economy continues to surprise to the upside.
A really solid economy.
We still have a long way to go on the inflation front.
Core inflation is above where it should be.
That's going to keep the Fed in this relatively hawkish tone for a while.
These central banks around the world have to continue to tighten.
They're catching up, but they have a lot of work still to do.
This is the key question. How far do rates have to go, and just how sticky is inflation globally? Joining us now to discuss, Invesco's Alessio DeLongis and Megan Robson of BNP Paribas. Megan, I want to start with you. How much are you resetting your expectations for inflation, given what we've seen in the UK, given what we've seen in the Euro region, and given the response from central banks?
So on our side at BNP, we do expect inflation to be sticky. So we're calling for one more rate hike in July and for the Fed to remain on hold for the rest of the year. For credit markets, I think what's very interesting as they've been very resilient despite this more hawkish message. We've seen credit actually hold in very well over the last week. We think what's going to drive markets for the second half is going to be the data. So, to the jobless claims we saw earlier today, we are expecting to see some softer data heading into the second half, and we think that's a catalyst for credit spreads to move wider as some of the tightening starts to filter through the system.
Alessio, do you think that the chances of a soft landing are higher or lower after what we've heard over the past couple of days with central banks globally ratcheting interest rates higher and the U.S. likely to do the same?
I think what we're learning is that it's really a time shift in that recession or soft landing, so to speak. I think for 2023, we can certainly talk about more of a soft landing. What we're learning through this policy cycle is that the level of the real rate that really leads to a slower inflation down to target, to levels that are consistent with target is a lot higher than we would have ever expected. Real rates are now at 2.73% in the developed world, which is something, especially in the short end of the curve, at 3% real rate is something that was unimaginable only a few quarters ago. But what that is doing is postponing that slowdown, and is postponing also the magnitude of that slowdown, the timing and the magnitude of that slowdown. When you look at the dot plot, it's implying over 100 basis points of cuts into 2024 and another 100 into 2025. Similar dynamics you're seeing in yield curves around the world. So it's really a question of softer landing today or no landing today as the economy is just cruising along a low growth rate, below trend, but absolutely just fine, and a postponement of that deceleration 2 years out, I would say.
2 years out, Alessio, and this is where I want to double down. Do we have a sense of what to look for to understand the long and variable lags versus just the insensitivity to interest rates, right? I mean, it's a distinction, and it's one that Fed officials are trying to make. What are you looking at to understand the length of this delay of the long and the variable lags that will eventually, in your view, catch up with the economy?
Great question. The lags historically have been between 1 and 2 years. Let's call it 18 months to be overly precise, just for the sake of simplicity. So when you look at where the tightening cycle started, that's just barely over a year ago. So by those metrics, we should begin to see the impact of monetary policy just around the end of this year and going into next year. When you look at the relationship between the inversion of the yield curve, the slope of the yield curve globally, and the level of market volatility, we see the 18-month to 2-year lag. The only variable, and I think Megan alluded to this earlier, the only variable that we see has had already an immediate reaction to the monetary policy tightening is the bank lending surveys on financial conditions, on lending standards. But we're not seeing that come through into credit spreads. So I think it's still too early to say that this time is different. I think the lags are still working as we have historically seen them, and that's why the unemployment rate is still at all-time lows. The unemployment rate is still reflecting past monetary easing and fiscal support.
Megan, do you agree with that, that's sort of the time frame that you're looking for some of the rate hikes to take effect?
Lisa, we do agree with that. So I think one interesting takeaway from first quarter earnings for high yield corporates is that for the first time this cycle, we've seen interest expense actually growing more quickly than EBITDA. So on a micro level, we're finally in that restrictive territory, name by name, for your average high yield corporate. And so over time, as we expect the Fed to remain on hold, we think that deterioration will start to be more apparent with interest coverage on a downtrend for the rest of this year.
And you think, Megan, that's going to be reflected in spreads widening more considerably, correct?
Yeah, so we're calling for spreads to widen. We think the difference between where fundamentals are today and where we will be later this year will be priced into spreads widening. And to the comment on tighter bank lending conditions, yes, spreads are not pricing that in, but we do see it in the primary market. So if you look at high yield issuance, much lower this year. It's mostly been refinancings, not a lot of appetite for M&A and LBO, and you have seen a pickup in secured issuance. All those signals tell you that credit conditions are tightening. It's happening slowly, and we think it's a matter of time before that is priced in.
This is the tension right now. What happens if the Fed does keep rates where they are, not perhaps even hike that much more, but not drop them lower? JP Morgan's Marco Klanovic talking about this, seeing U.S. stocks struggling without a Fed cut, writing, quote, in equities absent preemptive Fed easing versus Fed dots that imply 2 more hikes by year end, we expect a more challenging macro backdrop for stocks in the second half, with softening consumer trends at a time when equities have re-rated sharply. Alessio De Longis, there's a curiosity here, and Megan was alluding to this, certainly in the credit sphere, that you are going to see a reflection of this tighter policy more and more as time goes on. Is that true as well for the equity component, that they will wake up to higher rates more significantly later in the year?
Absolutely. And I think if you look under the surface, equities have already behaved accordingly. It's true that the overall equity market has posted very attractive double-digit returns. But when you look under the surface, this was all led by a very narrow market, very narrow leadership in quality mega cap names. That is a defensive rally. It's a rally that needs to be respected, but it's a rally that is not validating an economic recovery. It's a defensive rally driven by quality and low volatility names, mega cap names, while when you look at the lag, the underperformance in value, in small and mid caps, in emerging market equities, these are all the cyclical, more economic bellwether indications of the equity market. So I think the type of environment that we're seeing into the remainder of the year still justifies because of the low unemployment rate, still a relatively healthy market backdrop, but still led by cautious defensive sectors and styles in the equity market.
Alessio De Longis, Megan Robson, both of you are sticking with us. I do want to bring this to you, that Bank of England's Andrew Bailey has been speaking. He doesn't have a press conference after his release, but he was speaking to a gaggle of reporters, and he said that he's not trying to trigger a UK recession and that he'll do whatever it takes to cut inflation. Fed Chair Jay Powell has perhaps a similar message when he does head to Capitol Hill for day 2, this time in the Senate. We're going to be hearing from him as he testifies coming up today at 10 a.m. Eastern. Joining us now is Michael McKee for more on what to expect. Mike, what are you looking for today?
Not a whole lot different, Lisa. This is going to be a chance maybe, though, for him to explain the difference between a skip and a pause, and what the Fed is looking for in terms of how it makes its determination on whether it's going to raise rates again and when. Jobless claims today, an interesting case. They are up by 2,000 to 264,000 from the initial report last week, but that was revised up to 264. So basically, jobless claims unchanged. Doesn't look like there's any kind of mass layoffs going on, especially when you look at continuing claims. They fall. And if people were getting benefits, that number should be rising. So the Fed is looking at the labor market and saying this is still pretty strong. Now, yesterday, Powell told members of the House Financial Services Committee the process of getting inflation back down to 2% has a long way to go. In other words, we're going to raise rates. Austin Goolsbee, who had been one of the biggest doves, saying he's not decided what the rate decision should be because the meeting's more than a month from now. Raphael Bostic, who is not a voter this year, but still came out yesterday and said the bar to justify further rate hikes is higher than it was a few months ago. So the Fed hasn't made a decision on what it's going to do in July. The chairman hinting they will, Bostic hinting they are still quite divided. Markets have made their bet, though. The markets are betting on a recession and Fed rate cuts sometime down the road. It's not showing up in Fed funds futures, but I know you've talked about this earlier today, Lisa, the yield curve giving us a very strong message. It's the most inverted since Paul Volcker was in the 20th and C Street Fed chairman's office, and we were going into a huge recession there. And every time we go into, we have a yield curve inverted as much as this is, we get a recession. So we'll see if the markets have it right, if the Fed has it right. And I'm not sure Jay Powell's going to have a good answer for you today.
Or if it's the dreaded four words in the finance industry, this time is different. Michael McKee, thank you so much. Joining us now with a look at the stocks moving ahead of the opening bell. Here's Abigail Doolittle.
There's certainly a bit of a bearish tone this morning, Lisa, with the S&P 500 headed to its fourth down day in a row, the longest losing streak since May 4th. If it sticks on the open and the close, starting off with what is really dragging Tesla down about 3%. The stock now down closer to 10% in 2 days. Some of the froth from the recent trading coming out, and in fact today Morgan Stanley cutting to an equal weight from an overweight. Analyst Adam Jonas citing valuation, saying that the NVIDIA and AI froth has been hitting a lot of big tech. Boeing also down about 2.8% as its biggest part supplier. Spirit Aerosystems suspends production after union workers voted to strike. And then finally, Accenture, the tech consulting firm, falls on slightly light revenue growth. Bookings to be about the same in the current quarter from the last quarter, Lisa. It doesn't seem like anything outrageous there, but investors certainly not reacting to it well. That stock down about 5%.
Abigail, thank you. Coming up, all eyes on India as Prime Minister Modi meets with President Biden.
We're moving into a new era on foreign policy that is reminiscent to the old era during the Cold War, which is your allies aren't necessarily your perfect friends. India is a new big player on the world scene vis-a-vis China, vis-a-vis Russia.
That conversation still ahead. A softer tone ahead of the open. About 18 minutes to go. This is Bloomberg.
India is a new big player on the world scene vis-a-vis China, vis-a-vis Russia. So we're seeing now this new era of foreign policy, different sets of alliances and calculations.
Indian Prime Minister Narendra Modi holding a bilateral meeting with President Biden today. The pair expected to announce a series of deals aimed at improving economic ties, and Modi's timing is convenient. India's economy is buzzing and boasts a rapidly growing consumer market. Bloomberg's Enda Curran joining us now with more. Enda, how much is the focus really shifting from China to India as the main engine of growth and the partner that you want to be close to?
Well, there's some zeitgeist going on here, no doubt. Lisa, there's inflows into India's stock market, inflows into the bond market. People are talking about India now as a kind of an alternative, perhaps manufacturing centre, because sentiment towards China took such a knock over the past few years, both with the end game of COVID-0 and, of course, the geopolitical tensions. Obviously, business people are looking around. But, you know, it's not necessarily a linear story. The FDI data into India this year has actually cooled, by the way. It fell over the first quarter. And at the same time, you aren't necessarily seeing dramatic shifts of outflows from or changes in the FDI story in China either. So, yes, it's emerging as this potential alternative. People are talking about India in a way they haven't for a while. But I would just say that the China story hasn't completely gone away yet either.
How much, though, is this really highlighting the closeness of India to the U.S., even if they haven't been particularly vocal with respect to the Russia-Ukraine war or with what's going on with China and the increasing antagonism between the U.S. and China?
Well, the US has clearly been pushing for this relationship to get on more solid ground over the past few years. We've had the new Indo-Pacific term getting rolled out. We, of course, have had the Quad getting rolled out, bringing together Australia, Japan, India and the US. Now you have this meeting, the state visit, lots of expectations around some commercial deals, some military cooperation expected as well. But at the same time, Lisa, India does take its own path in foreign policy. Like you mentioned, it hasn't gone down the road that many Western nations have when it comes to the stance taken on Russia's invasion of Ukraine, for example. There still are significant differences on that front. So India follows its own path, but there's no doubt that the US is trying to leverage it as an ally in that important part of the world, and of course as a counterweight to China's influence in the region too.
Andy Curran, thank you so much. As we do await for a joint press conference later in the day, Alessio DeLongis and Megan Robson still with us. And Alessio, I'd love to get your sense and how much you're watching some of the the geographic changes in alliances as you shift into figuring out how to veer into the developing world and the assets that you like best.
Well, you know, India raises it's a very interesting topic because it's one of those countries or regions, really, given its size, that plays, as of today, a much larger role geopolitically than it does in global financial markets as of yet. It's an both economically and financially, it's an economy that, compared to China, compared to definitely the rest of Asia, has much more of a closed economy with less reverberation, less impact on the global economy, despite the size of its GDP. Its exports and imports as percent of GDP, one of the lowest in the emerging world, and similarly, on the capital account side, they're very close. So it's an economy that offers great potential for migration upward in its integration in global capital markets. And I think the emerging markets universe actually needs more of that presence, more diversification away from the pure manufacturing play that Asia has represented for a long time.
There are two ways to play this. There's the one hand with Alessio talking about potential investment opportunities and where the growth is going to come from. And then the flip side is, where are the investors going to come from for U.S. debt? And Megan, I'm wondering, when you look at the granularity of that, and where money is coming from to buy some of the securities once dominated by Japan, once dominated by Chinese investors, once dominated even by European investors, where is it coming from today?
Lisa, so we have a variety of investors still buying credit. I think for investment grade, you have a really strong LDI demand, primarily domestically in the U.S. For IG, you also see Japan, to your point, being very important. So we're watching Bank of Japan policy in July and what they proceed to do with yield curve control as an important driver. In our base case, we do think the BOJ will increase the target of YCC to 100 basis points. And so you might start to see some of that demand from Japan start to decline a bit. But overall, our preference in IG is for the long end based on that stability that you see from yield buyers still.
So from the investment standpoint, Alessio, where are you seeing the greatest opportunity when you look outside of the U.S.? And are those opportunities looking better than even what you're seeing in the United States?
We're seeing really great opportunities to begin to harvest attractive yields in the fixed income space, in the Eurozone and in the UK. We are seeing, it's true that the yield curves are meaningfully inverted and are likely to remain so for a prolonged period of time, but moving duration towards the intermediate part of the curve, where we're seeing nominal yields in the IG space at 4-5% levels, with an inflation picture that is expected to decelerate very quickly towards that 2% target by 2024. These yields offer very attractive real yields. We've mentioned earlier, just look at the 2-year part of the curve in the UK, in the Eurozone or even in the United States, we're seeing real yields that we have not seen in a generation of this investment community. So as we're seeing the higher likelihood of a larger recession into 24 and into 2025, right now, in the face of this tightening cycle, I think beginning to harvest those real yields in the intermediate maturities is a great opportunity to start diversifying away from equity markets.
Just as we reset with about 8 minutes to go here until the U.S. Open, Alessio, from your vantage point, how have you reset your mid-year expectations, your views in terms of where you see opportunity heading into year end?
I think heading into year end, we are at a bit of a pivot point. We are currently positioned defensively. We still think, as we just said earlier, maintaining a quality bias in those equity market exposures is a sounder approach than throwing in the towel on equity markets. We are not in an environment in the economic data or in financial markets to really position in an overly bearish way, waiting for that recession. This bearish positioning needs to be validated quickly, and this is not the environment where the economy is going to validate that bearish position. So maintaining a defensive portfolio while being fully invested both in equity and fixed income, but within equity and fixed income to tilt towards the defensive sectors and styles. As we said, maintaining that longer duration posture, especially through the exposure to quality and low volatility stocks. However, there will be a point in my mind in the summer or in the fall where if the inflation picture falls very quickly while the unemployment rate, it remains at all-time lows, the market will give another shot at a risk rally more in the cyclical sectors, very similar to what we saw at the beginning of this year. Between December 2022 and February 2023, we had a very powerful quarter of risk-on pro-cyclical rally, which was not the beginning of a new cycle, but rather a pause while we wait for that recession.
Alessio DeLongis, Megan Robson, both of you, thank you so much for spending time with us this morning. Coming up, the morning calls, and later, Mark Heffley of UBS joining us around the opening bell. This is Bloomberg. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Bernstein upgrading Kellogg to market perform, $62 price target. The analyst optimistic on an improved earnings outlook and spin-off plans. Next up, Deutsche Bank upgrading AB InBev to buy, price target of €60, seeing the company's headwinds likely to fade. And finally, Bank of America downgrading AES to neutral, price target $23. Coming up, the market open. This is Bloomberg. Just seconds away from the opening bell, hawkish central banks lower prices on equities. That has been the theme, led by the tech sector. NASDAQ index down 0.4% as we head in to the opening bell. S&P futures lower by about 0.25%, same as Russell 2000. Yields higher on the front end as people take into account the fact the Bank of England and the Norwegian central banks both surprised to the upside with 50 basis point rate hikes. And we do get some more expected to be hawkish proclamations from Fed Chair Jay Powell in about a half an hour time as he takes the seat on Senate floor, on the Senate front of the Senate Finance Committee in day 2 of his semi-annual testimony. We've been watching this grind higher and how it's affected some of the stocks that have been bid up most and those that have lagged behind. One stock to watch at the open is Boeing. The company's biggest supplier, Spirit AeroSystems, suspending production after union workers voted to strike. The dispute comes as Boeing prepares to increase output of its 737 MAX jets. Abigail Doolittle is back with us for more. Abby, what's the latest?
Well, yeah, shares are lower, Lisa, by about 3% as investors fret about the fact that Spirit AeroSystems, its largest supplier, its production, as you mentioned, is halted over the fact that their workers are striking. They're hoping to rejuice the growth. If you look at the financials on this company, because of some of the tragedies in 2018 and 2019, I believe, there are are big declines. Revenue, on the other hand, has been growing. This year it's modeled to be at 15.5%. But if they can't get the parts to make that cash cow plane, then there could be a real problem. So I think that that's what investors are really fretting over here. The stock on the year up a little bit less than 10%, so underperforming the S&P 500 at this point. But it's really going to be a matter of how long this strike goes, a complete unknown. The longer it goes, the more it's likely to weigh on this company and the prospects of being able to get that revenue growth that analysts are modeling right now, Lisa.
Thank you so much, Abigail. We're also watching something similar over at UPS. Turning to tech, NVIDIA is now one of the most popular stocks among investors looking for an ESG play, particularly if they're looking for AI exposure. Investors say they're turning to the chip maker for its risk management processes and the steps it takes to be environmentally friendly. Katie Greifeld, NVIDIA, an ESG stock. Explain.
NVIDIA is ESG. You heard it here first. Bloomberg crunched the numbers, and based on filings, there's now over 1,400 ESG funds that directly hold this chip maker and a further 500 that are indirectly exposed. Now, according to Bloomberg data, that makes NVIDIA more popular than traditional ESG names such as Vestas Wind Systems and, of course, Tesla. Now, that's obviously been great news for those ESG funds since NVIDIA. It's up nearly 200% this year. And I want to point out that this chip maker, it holds their annual investor day today. So we'll see if the executives can deliver on that hype and keep it going. And it's also worth noting that competitor C3 AI also holds their annual investor day today. And if you look at the performance so far, you can see that C3 AI, it's higher by about 250% so far in 2023, but still far away from its all-time high. So we'll see how today goes, Lisa.
I'm glad you mentioned the investor meetings. We'll be watching those closely. Katie, thank you. Sticking with tech, Morgan Stanley downgrading Tesla to equal weight, price target $250. The analyst rating, quote, "We see Tesla as an AI beneficiary and an auto company. High expectations on the former has brought the stock to a fair value." Meanwhile, Amazon in the spotlight. The e-commerce giant is being sued by the FTC. The agency says Amazon allegedly duped customers into signing up for its Prime membership service and then made it difficult to cancel. Isabel Lee has more. Isabel, a lot of people have had trouble trying to cancel their membership. What's the latest?
Hi, Lisa. So that's exactly the crux of this whole lawsuit. So it's so hard to cancel an Amazon Prime membership, which, by the way, costs $139 per year, that FTC said that a subscriber has to go through 5 pages when using desktop and around 6 if using mobile. In fact, internally, it found out that Amazon called this process the Iliad in reference to the epic poem that detailed the final year of the 10-year Trojan War. So around 167 million shoppers have Amazon Prime. That number has been kind of unchanged since the last year. And FTC said that Amazon is duping its customers, that it's not good. And this isn't the first time. They're not really singling out Amazon because FTC did start looking into this in March. So it may crack down on other companies. Year to date, though, Amazon is up around 50%, far outpacing S&P and the NASDAQ, Lisa.
Isabel, thank you so much. Turning now to banking, Deutsche Bank CEO Christian Saving telling Bloomberg in an exclusive interview that while he sees a possible recession later this year, the bank itself is seeing growing momentum, expecting trading results in the second half of the year to improve. Saving saying, quote, "I think economies have really shown how resilient they are. We could already see also now in June on the most recent days that there is the momentum in the business." Bloomberg's Guy Johnson joining us now with more. Guy, I got to say, really interesting to see an increase in expectations for trading after so many people wrote off so many sections of banking just in general due to perhaps an upcoming recession, maybe not.
Well, I think there was an expectation that the macro environment, Lisa, was going to be stabilizing, and that, in theory, should be bad news, particularly if you're a fixed income trader. Saving basically implying that he doesn't think that's going to happen. It's interesting. He talks about the fact that he thinks that actually there's going to be momentum in the second half of the year. His CFO, James von Moltke, warning a few days back at a conference that actually we could see a 15 to 20% decline in FIC for Q2. He's now saying that likely is a blip, and we're going to continue to see the volatility going forward, and as a result of which we think it is going to pick back up again. You've only got to look at today, Lisa. Look at what is happening. 50 basis points in the Norges Bank, a surprise 50 from the Bank of England, 25 from the Swiss National Bank. The macro volatility continues, and we're going to hear day 2 of Powell a little bit later on.
Guy, thank you so much. Mark Heffley of UBS preferring fixed income to equities, writing, quote, investors face a balancing act. There is a path higher for stocks, but it is a narrow one. After a strong run, the upside to stocks is now limited, and increasingly bullish equity market sentiment speaks against chasing the S&P 500 higher. Mark Heffley, I am so pleased to say, is joining us now. Mark, even though there has been this feeling of a no landing suddenly resurgent among a lot of analysts, why do you push back?
Well, I think you're seeing it today with the Bank of England, right? Surprise, inflation continues in Western economies, and the central banks feel compelled to attack that aggressively. And of course, the FTSE is off today along with other indices. So I think one pushback is that the inflation picture is far from certain. And then the second picture, particularly for U.S. equities, is these valuations are stretched.
Right now, we're looking at the potential for interest rates to come down pretty dramatically, or at least at the long end, if growth does slow materially. Are you doubling down on that essentially with your fixed income call, that we are going back to a regime in which interest rates and rates remain low?
Well, the funny thing is that you don't have to double down on that, right? Because the market's already pricing that interest rates are going to fall off, but that earnings for companies are going to be strong. I think consensus is for flat earnings, not a fall in earnings. And so therein lies the difficulty with stocks going higher. But I think that, when you look out longer term, there certainly are forces that we believe will take some of the inflation out of the picture and create a more benign environment. The question is, how much does the economy have to slow to get there?
One thing that I've noticed is in the themes as people reset for the mid-year review is that AI seems to save everything. And basically, this is the haven if you believe that inflation's going to run amok. It is the haven if recession comes along and kills this consumer discretionary. It is the haven if you don't know what else to do. Do you buy into this, Mark?
Haven, to quote Paul Simon, every generation throws a hero up the pop charts. I mean, I think, look, it's been an amazing run, and there's no question over the longer term, AI is going to mean something. But things have gotten very, very stretched here. And over the near term, you try ChatGPT once and you say, wow, this is amazing. You try it twice and you start saying, hey, sorry, these answers don't make any sense. And I think the market might take a second look and get some of that feeling as well.
So how do you recommend for your clients around the world who are trying to get in on some level? Do you say just pump the brakes for a second? You might want to sit this one out.
Well, I think that the most important thing for people is to play the whole chessboard now, because with such a concentration and a run-up in U.S. equities, we're looking at things like emerging market equities, which trade at a 36% discount to U.S. equities. We're looking at things like emerging market bonds, which have very attractive yields. And we're looking at a weaker dollar and what that could do for both, say, oil and gold. So this is a time probably for a lot of clients to diversify.
When you talk about diversification and going overseas, how much are you sort of encouraged by the moves that you saw from the Bank of England, the Norwegian Central Bank, as well as even Turkey today, that there seems to be a real discipline and a desire to get inflation under control with significant rate hikes?
I think that getting inflation under control and not letting those expectations become unanchored is critical. And, they have not yet become unanchored in the United States. And I'm sure Powell will add a little extra vim and vigor to his testimony today, given what his colleagues across the globe have done.
What would you have to hear, or what could cause concern enough for you to move away from your fixed income call in terms of not necessarily doubling down on the inflation fight enough in the U.S.?
Well, I think that what has surprised us a lot has been the continued strength of the U.S. consumer. And, as long as that consumer is able to spend, especially for the U.S. economy, that's going to keep the economy booming and earnings strong. So that's one of the things that we're watching very closely.
And how much does that sort of discussion around student loans coming, the payments coming back online in October, this idea that some of the fiscal spending, the roll-off is going to start to take effect more substantially in the next couple of months, does that ring true to you, that will actually decelerate consumer spending a lot more than has been seen to date?
Well, I think it fits into a broader discussion. If you look at, consumers have been so confident. They've really been willing to run up debt, credit card debt, other kinds of debt. And so we're looking for it more in the spending and the borrowing. And, we've seen personal bankruptcies go up a little bit here. So, I wouldn't focus on one metric in the debt. I'd probably look a little more broadly at the metrics coming through.
We're speaking with Mark Heffley of UBS, who has a rich history in trying to understand how best to allocate in difficult times. And Mark, one question that keeps coming up is 60-40 debt. A lot of people say it's actually the most alive it's ever been if you look at returns on both, just absolutely supporting one another. How are you advising going into the second half? Are you basically saying it should be 80-20, or are you saying it's got to be more 50-50 with just a more discerning look at the 50 in equities?
Well, we're away from 60-40 because we think alternative assets, which have grown so much as a proportion of the market, need to be part of that equation. Now, what the exact numbers are really depends on what stage you're at your life and how much risk you can sleep with. But I think that the 2 points to take away are, one, alternative assets, hedge funds, private equity, private credit, they seem to be low in a lot of our clients' portfolios. And then secondly, I think all of us are getting reacquainted with yield now that we've moved convincingly away from the zero bound on inflation and interest rates.
One thing that's funny is that as you talk about private credit, your colleague at UBS, Matthew Mish, put out a note last night talking about private credit default rates expected to peak at around 9.5%, saying that there are opportunities, but there also are these potential pitfalls. How do you navigate at a time when people are still expecting pain in the economy and these interest payments are expected to rise substantially? How do you identify the companies that can withstand that, the non-zombies amid the zombie universe?
Well, I think this is a great question because, if you think about it as a client, from a client's perspective, that has underallocated to that sector, and many clients don't even know what private credit is. They're looking to deploy capital now into new funds, and what you see is that it's the funds, the vintages of funds that are started after equity markets have had a 25% sell-off like they had last year. Those are the funds that tend to perform the best. So, the headlines are about the companies that are currently in portfolios that are perhaps doing badly. But for investors today, it's how do I reap the benefits from that as capital is constrained in the sector?
Mark, before I let you go, what do you think is the biggest mistake that so many investors are making right now? What do you think is the biggest wrong assumption that is prevalent in markets?
Well, everybody buys what was working last month. And so, we've seen this tremendous run up. You were talking about the holdings in NVIDIA, and, that's great. But it's really about what's next month, what is going to happen with the economy, what is going to happen with earnings, and then look at these stretched valuations.
So in other words, you think that people are perhaps overweighting stocks a bit too much. Is that correct?
Yes, overweight stocks. Try to get some yield in your portfolio at this time. It's a much better risk-reward trade given the potential for volatility to rise.
Mark Heffley, thank you so much for taking the time. And you are talking on a day 4 of declines right now in U.S. equities as banks around the world, central banks, do put out hawkish proclamations. You've got the Bank of England with a 50 basis point rate hike, as well as the Norwegian Central Bank. We're seeing the NASDAQ actually turn positive, so you can't keep a good tech stock down. S&P 500 down 0.2%. The Russell 2000 still lower by the most, taking a deep leg lower about 1%. And you are seeing in the bond space yields higher, price lower as people game out higher for longer. You're watching The Open. This is Bloomberg. The race to dominate the electric vehicle market continues heating up, especially when it comes to competition with China. We got word this morning of a $9.2 billion loan that the U.S. government was extending to Ford to create 3 factories of electric vehicle making as the U.S. tries to gain a competitive edge against China, which has dominated the industry for so many years. This really speaks to a groundswell of fiscal support for all things tech in the U.S. Joining us now with the auto angle is Keith Naughton. Keith, I'd love to get your sense, first of all, of how unique this $9.2 billion loan actually is and what we know about the details of its terms.
Yeah, it's one of the largest government loans given to the auto industry since, the bailouts of General Motors and Chrysler more than a decade ago. So it's a big loan. General Motors received a similar loan late last year, but it was $2.5 billion. So this is much larger than that. It goes to both Ford and its battery partner, SK On of South Korea. They're building 3 battery plants, 2 in Kentucky, 1 in Tennessee, that'll utilize this money.
We've heard about a lot of people saying this is going to revolutionize the EV manufacturing industry. Is that true, Keith? Do you actually believe that there is the will to build this, to staff it, and then for it to become a competitive behemoth versus what China offers?
Yeah, so Ford is pouring $50 billion into developing and building electric vehicles, and they plan to be building it at a 2 million annual rate by the end of 2026. This is a key part of that because batteries are the most important aspect to scaling up production of electric vehicles. Ford CEO Jim Farley has said in our story. So this is key to trying to catch up to China, which is the world leader in electric vehicles and batteries and battery materials.
Do we know what the terms were of this loan, Keith, what the strings attached really consist of?
Well, as the Department of Energy explained it to us, it is certainly better terms than Ford would get if it were to go to Wall Street and just borrow this money. So, it is a good termed government loan. They didn't give us precise details.
Well, how much is this really Ford getting, I don't want to say bailout, but getting assistance from the U.S. government to build these plants because it doesn't have an investment grade rating versus General Motors, which does, and can probably access the capital markets at a much lower rate?
Yeah, so, the Department of Energy and the Biden administration views this as critical to U.S. industrial policy to try and catch up to China on electric vehicles. So that's why they have a pot of $400 billion that they are doling out to automakers to try and catch up in the battery race. But China still controls so much of the battery supply. 80% of the lithium-ion batteries come out of China. So, and all of the minerals and the mineral processing is coming out of China. So there is a long way to go before the U.S. catches up.
Do we have a sense of what could be next in terms of the deployment of the money that's already been promised?
Yeah, so Ford and SK are building these battery plants right now in Kentucky and Tennessee. They'll be operational by the middle of the decade. But there's more to come, too. Ford has a separate battery plant that's not part of this loan that it's doing in Marshall, Michigan, that uses technology from China's CATL. So there's this huge rush of building of battery plants and EV plants. There's almost $200 billion worth of investment going into that right now throughout the auto industry in the United States.
Keith, you've been covering this industry for decades. Do you hear from the people who are inside the building, in the C-suites, that they think that this is truly a game changer in terms of the financing from the U.S. government?
Yeah, I mean, this electric vehicle industry in the United States can't take off without some government support because that's what's going on in China. That's what's going on in Europe. And it is the future of mobility. Carbon-free future. That's how mobility is going to go. So you need some support to get the EV market off the ground in the United States. It's still less than 1 in 10 sales in the United States. So there's a long way to go before electric vehicles dominate this market.
Keith Naughton, wonderful reporting. Thank you so much. I really appreciate it. Let's take a quick look at sector price action this morning. Abigail Doolittle. Abby.
Hey, Lisa. Well, the decline for the S&P 500 may be small, about 0.1% down, but we have a number of sectors that are down more. Real estate and energy both down more than 1%. Materials down close to that amount. Up top, we have some defense, consumer staples, and healthcare. As for the chip sector and AI, it is down for a 5th day in a row, the longest and worst losing streak since the end of April, down about 5% over that time. So the big question remains, is air coming out of this AI chip bubble?
Abby, thank you so much. Coming up, the market moving events that you need to be watching. That's next in our Trading Diary. Now for the trading diary, you need to be watching through next week. Fed Chair Jay Powell testifying in the Senate at the top of the hour. Plus, we'll get U.S. existing home sales rounding out the week with Fed speak from Jim Bullard. On Tuesday, we'll get U.S. new home sales data as well as a read on the consumer confidence from the Conference Board. And next Wednesday, the Fed releasing the results of its bank stress tests. Plus, we'll get Micron earnings. And later today, we do get the NVIDIA meeting of shareholders, which should be interesting. Right now, we are seeing in markets, NASDAQ getting forward, 0.3% gain. This was Countdown to the Open. This is Bloomberg.